All right, now let's see how the NPV and the concept of the discount rate is applied in an Excel format so that you could get a better understanding of these concepts. So let's look at the first one right here. First, you got to download this file. This file is part of the file here that you can download, and just go to the NPV worksheet here. You can ignore the other ones for now because we're going to use this file again later to look at the internal rate of return. All right, this first part here is the one future payment. All right, if we have a future payment, let's say of $1,000 coming in 5 years, and it's discounted at 10%, what is its net present value today? So we see here that it's calculated at 621. So if I click on this right here, we see the formula. The formula is saying it is equal to the future payment divided by 1 plus the discount rate, which is raised to the power of 5 years. And if you change any of the assumptions here, so let's say if you increase the value in the future, then this will increase. If you decrease it, it will decrease as expected, right? And then the more years you discount it, the lower the net present value of that future payment. So let's say instead of 5 years, it's coming in 10 years, you're going to see the net present value drop quite a bit. Okay. But what if you change the discount rate? So it's taking 10 years instead of 5 years, but let's say it's at half the discount rate. Well, it's going to go back up again. Okay. It doesn't exactly completely offset, but you see that if you increase the discount rate or the time, or changes anything to the rate or the time component, you're going to affect the net present value calculation. So you change any of these, you're going to change that. Just play with the numbers, put in, different values here and put in different assumptions and put in different discount rates, and you can see how the net present value will change based on that. All right, now let's take a look at what it looks like if we were to evaluate two different options, okay? Let's look at an example here. So the example here is you get $750 today, or you can get $100 a year for 20 years. All right, so $100 a year for 20 years. Which is the better option? Well, the $100 a year for 20 years, you're going to be collecting $2,000 over 20 years, whereas the other option, you get $750 in just today, right? And if you're only looking at the total dollar amount, and you don't look at the time value of money and you're not discounting these future $100 back, then of course option 2 is better. But as you've learned now, we need to discount it, right? So let's look at what it might be if we have a discount rate of 10%, okay? So because this is already in today's value, we don't need to touch anything in terms of the option 1, but we need to discount all of these future values for option 2 so that we can compare it apples to apples. All right, so let's see what that looks like. So if we calculate here, I'm going to use the net present value calculation for each of these payments. So we see here that the $100 in a year is only worth $91 today. And then the further you go out, let's go all the way out to 20 years, the $100 in 20 years at a 10% discount rate is only worth $15 today. So what's the value of all of the discounted net present values of each of those payments? Well, we simply sum all this up. And when we do, we get this calculation of the net present value. So we see here that if you have a discount rate of 10% applied to this option, then you're better off by going with option 2 because this net present value is greater than the option 1. So there is some discount rate at which this net present value is actually going to be worth less than that value today. So let's say if your discount rate is really high, let's say 20%, you see that the net present value of that stream of cash flow is only worth $487 to you. What that means is instead of looking at this option, collecting $100 over this time frame, you're better off by taking this now because you're able to collect 20% returns on this. This here, there is some rate of return that once you surpassed it, your discount rate makes it more worthwhile for you to just take all that money, the option A. What is that? Well, there's one way we can do that, and it's a really cool tool in Excel that allows us to solve for the discount rate where the option between 1 and 2 basically will be the same in terms of its net present value. And so the way we do that is we take this value here, We go to the data, we go to what if, and then we go to goal seek. Okay, so the goal seek, what it does is it helps us solve for something without having us to go repeatedly punching in something, a number there to try to see what it is. So what we're going to solve is we're going to set this net present value to equal to that value, which is 750, by changing the discount rate. Okay, and when we do that, it's going to automatically calculate a discount rate where it sets the net present value here. So what this is telling us now is if your discount rate is higher than 11.9%, then you're better off by taking the option 1. But if it's lower than 11.9%, and for most people it's going to be a much lower, then you're better off with option 2. Now, let's look at a similar example, but slightly different. Again, option 1 is 750 right away, but option 2 now is $200 a year over 10 years. Basically, you're getting the $2,000 in 10 years versus the $2,000 over 20 years. So now you're getting more of the cash coming in earlier, which if you had to guess, what would that break-even discount rate be? Would it be higher or lower than the previous example here? It should be higher, right? Because now you're getting more of that money earlier. Let's see what it looks like. If it's at the same discount rate, we'll see that the discounted cash flows, we calculated back. And then when we sum them over all of them, we see that the net present value at the same discount rate from the previous example, now it's at 1135, which is much higher than option 1. So if we do the goal seek again, we'll see that the indifference discount rate between these two options is going to be much higher. Okay. And let's see what that looks like now. Let's set this one to 750 and then by changing discount rate. There we go. So we see that, wow, in order for the two options to be identical, basically your discount rate is going to be 23.4%. So what it's saying is if you have a discount rate or an opportunity cost that is lower than this, then it's going to be better for you to take option 2. So when you look at these net present value calculations and these options, what it's telling you is you should never just look at the nominal value or what the dollar amounts are. In option 2, for both examples, the total dollar amount is $2,000. But the timing of it, what your opportunity cost would be, factoring both of those in will help you to make a better decision about which option is better.